from the heart of Dubai, where tomorrow is being built today, to the world. Welcome to the CTO Show with Mehmet. Here, we redefine technology and reimagine possibilities. With Mehmet, delve into the riveting realms of AI, cybersecurity, and digital technology. Experience the thrilling highs and lows of startups. Immerse yourself in the spirit of entrepreneurship and witness the future of business innovation being written in real time. Now, without further ado, let's tune in and explore the future.
Hello and welcome back to a new episode of the CTO Show with Mehmet. Today I'm very pleased joining a friend, which I knew him since a long time now, I think almost 2 years, Gagan. So Gagan Singh is the founder and CEO of Valuation Global. The way I love to do it, Gagan, is always I keep it to my guests to introduce themselves. So tell us more about you, your journey, and what you're currently up to, and then we can take the conversation from there.
Thanks, Mehmet. It's an absolute pleasure to be here on your show. So for your audience, hello everyone. My name is Gagan Singh. I am founder and CEO of Valuation Global. Before I tell you what I do right now, I would like to share a little bit of my backstory because that will give you a better context. So I'm originally from India, a very small town in India. Started my career in corporate finance, worked in India and overseas for the first few years of my career. Became a venture capitalist in 2013-14, wild west days of venture capital. During those days, I was based in Thailand. So I joined a fund called Inspire Ventures. It was a $40 million fund, early stage sector agnostic. So I was part of their team. I was there in the capacity of partner. So ran that fund or was associated with that fund for roughly 2 years when the fund did almost 7 to 8 deals during my tenure there. And after that, went into entrepreneurship with this B2B tech logistics company called Delivere. So Delivere was started in Thailand and was actually incubated by the same fund I was working with. So we started Delivere in Thailand, then expanded to Indonesia and then Philippines. I ran Delivere in the capacity of group CFO for roughly 7.5 years. And during my tenure at Delivere in total roughly raised $120 million in equity and debt financing. So the company grew pretty well. But so had a great experience of being on both sides of the table. So combined my skill set and decided to do what I'm currently doing at Valuation Global. So in 2022, I decided to quit my full-time role at Delivere. I was also part of the board, so I resigned from board as well to build Valuation Global. And as I said, it essentially does what a VC and entrepreneurship problems had to solve all the problems that I personally faced. So Valuation Global is essentially an operating system for private markets where we work with venture-backable businesses and help them raise capital. It can be primary financing, that means raising fresh money. We also facilitate alternative transactions like venture debt, term loans, revenue-based financing. So that's a very active part of our offering. And last but not the least, we also facilitate secondary transactions. That means selling a portion of founders' equity or selling a portion of early investors' equity to clean up the cap table. But that is only applicable for mid to late stage companies, particularly Series B and beyond. And all our offerings, that means in terms of private markets, are available for accredited and institutional investors only. So we are not a crowdfunding platform. Now, our core offering actually has 2 parts. That's how I would like to put it. One is the tech stack, and the second one is a network. So when it comes to tech stack, you can say Valuation Global is essentially Kata and AngelList combined. So we haven't reinvented the wheel, neither we aspire to. But what we did was we brought all the tools together at one place. So for the companies in our network, we have tools like cap table management, ESOP management, listings, profile management, so virtual data room. So whatever the company needs in order to raise capital and to look and feel in a certain standardized and proper corporate governance fashion, we provide that. While for the investor side, we act as in the active deal flow partners, but our tool also works as the portfolio management tool for them as well as investor relations. But Mehmet, you know as much as I do, tech is just one portion of our offering because the nature of the business is such that only tech cannot solve the problem. It is nice to have, but ultimately it's a very relationship-based nature of the business that you need to know people personally in order for them to trust you and to invest in the companies that you present. So I'll say 50% offering, and that's bringing me to our second core offering is of network. So today we work with roughly 400 institutional investors out of Southeast Asia, majority of which are either venture capital firms or private equity and family offices. We also work with quite a few ultra high net worth individuals, but that's still comprised of roughly 15% of our network, because even in ultra high net worth with individuals, we haven't seen check sizes above $1 million so far in each transaction, whereas for institutions, typically the starting point is above $1 million US. So yeah, sorry for the super long intro, but I hope that gives your audience full context of my background and most importantly, why I'm doing what I'm doing at Wows Global.
No, that's fantastic, and thank you again for I know how things get busy, and you are in a on a mission actually to help like both sides of the table, and we like even before the podcast, I mean in real life we talk a lot about this. So you've been, I would say, on the both sides of the table again. So there must be some common I would call them patterns, right? That you spotted, that you said, what, like there is something missing over here, right? And I love always, on the show to ask anyone who comes up with these fantastic ideas and turn them into life. And to your point, it's not the technology, it's more about, what problem we are solving. So like, when did you decide that, like, what, like really I need to build this thing because, you saw the gap. So I'm really interested to understand, what like the major gaps you saw, because you mentioned a couple of platforms and so on, but like really the real problem that both sides of the table face today for their journeys.
So that's a very interesting question, Mehmet. So if I'm not wrong, what you're trying to learn is what was the genesis of this idea?
Exactly.
So it's actually my personal problem. So what happened was when I became part of Delivery, I was roughly in my late 20s, 29 years old I was. And I ran that company until I was 36, 37 years old. And during that time, the company grew considerably. So right from 0 to 1 in real sense. A company which was not doing anything on day one, eventually we saw a very sizable top line revenue in 9 figures, top line GTV, in fact. So we saw considerable growth. And during those 7.5 years, a lot of life happened to me. I mean, I lost my father in 2016, which was extremely devastating for me personally. I had my son 6 months later in 2017. So a lot of life happened during that time. So balance sheet wise, my assets were looking pretty good because I was holding shares in the company's valuation was going well. So balance sheet wise, I was very comfortable, but I didn't see any liquidity against those shares. And that kind of bummed me up because it would have been nice to liquidate a portion of my equity and perhaps diversify my assets, because a majority of my assets still sits in private companies' shares. So it's extremely risky, right? Now, since I'm no longer part of the company, it further sometimes makes me nervous because what if the company is not being run in the way when I was there, and all these. So long story short, there were multiple instances during those 7 years when I wanted to sell a portion of my equity and diversify my assets, probably invest in real estate, perhaps probably put a small portfolio in crypto back then as well, which wouldn't have been a bad idea actually, and perhaps bonds and all these things, so that at least my family is secure. But that didn't happen. I didn't see any liquidity against my shares. And Delivery was not a small company, it was a Series C company. So, and I was like, if I am facing this problem, perhaps there are so many startup early stage employees and founders who would be facing the same problem. And then I looked at the West, and then I discovered this company called Forge Global, which was actually very active in the secondary market space. And they were $2 billion back then. Now their valuations have dropped, but back then, and when they also went and did IPO, so their market cap was roughly $2.1 billion. So I was like, okay, Southeast Asia perhaps can use a similar platform where people can get liquidity against their assets. So that was the genesis of building Wows Global. But over a period of time, one thing led to another. So when we started building the marketplace, we realized that private company shares are very different from public company shares. They come with a lot of inherent restrictions and sometimes a lot of fraud. Also, it's akin to that kind of fraud. So unless we have visibility on the shares, we can't build a scalable secondary market. So that's what led us to build cap table and ESOP management tool. But then what happened, by the time our tool was completed, that was the marketplace and the cap table and ESOP management, the funding winter came. And forget about secondary market. Private market was not getting any traction. So you're like, okay, what do we do? So we found ourselves in a limbo by late 2020 to early 2023. So that's when we like, okay, we've built this tool. We can do secondary markets. But if we add virtual data room here, we can perhaps cater to primary requirements of the companies as well. And primary raising capital was even more tough. So I thought with my experience, I could help a lot more companies raise capital at a faster pace. So then instead of just doing secondary, we started doing primary. And then after primary, we got some debt service partners who said, hey, Gagan, there's so many good companies. We would like to service debt to them. So one thing led to another. And today we are full-fledged end-to-end integrated system. But coming back to your original question, what was the genesis? I'm just trying to solve my own problem, but bring liquidity to the very elusive private market space.
Absolutely. Like that makes a lot of sense because they always say like the best startups comes when the founders, they face it themselves, right? So they understand it and then they validate like other people, they have the same problem, which is of course like you guessed it, and you guessed it, of course, again, in the right way. Now, before we move to the investing, which is the most interesting part, to be honest, because I know a lot of the founders and even the investors that will be watching or listening to us, this is what will attract them. But I want to start because I believe, and because you touched base a little bit on it, but I want like a little bit to extract it more. The cap table and the ESOP, right? So these two, I think they are the two most mysterious, because I talk to a lot of founders. And for them, they sometimes are like, what? Like, what are you talking about? And then they start to figure out, and then they go and do some research, and oh yeah, we need to have the cap table ready. Oh, like now we're gonna raise the first round, and then we need to prepare things, and then especially they get it when they move from, let's say, maybe C to Series A and above. And the ESOP, they start to think about it. Oh, like this is what they do like in the West, and now this is how we have to shift also to building this. So what are the challenges that you have seen in that space specifically when it comes to the cap table and the ESOP?
I think your question had the answer in itself, Mehmet. It's the lack of awareness. And it literally shocks me how little awareness do people have in Asia and Middle East on the cap table. Trust me, like I'm pretty sure most of your audience cater to the startup space. And this is a question for themselves. Do they really understand the difference between the post-valuation cap and the pre-money valuation cap and the impact it has on the cap table? Let me tell you, today the industry standard of raising safe note, that means simple agreement of future equity, is post-money valuation cap. That's the industry standard. So everybody says, I talk to everyone, how did you raise capital? Hey, Gagan, we use this Y Combinator grade safe note. It's an industry standard. We are using it. And my answer to them is, you have done a disastrous mistake. Because previously, when this safe note was originally presented by Y Combinator, it had a pre-money valuation cap. But now in 2019-20, they changed it to post-money valuation cap. And I'll tell you how this difference is impacting the founders, which majority of the founders don't have zero idea of. Like if it's a pre-money valuation cap, it works pretty simple. So for example, you and I are founders in the company. We own 50% of shares in the company. Now a third investor comes, or a new person comes who says, I'm going to invest up and take 10% of the equity in the company. Now in that case, you will lose 5% of your shares. I will lose 5% and they will have 10%. So 45, 10. Now say another investor comes in who says, I'm going to take 20% of the company. Now in that case, you will lose 20%. That is 45, 20% of 45 is 9. So you will have 36%. I will have 36%. the investor before us will have 8%, and the remaining person will have 20%. So that means the first investor who came will also be diluted. And that's how it works, right? Simple calculation. So everybody reduces on a pro rata basis. Now, you know what post-money valuation cap does? In this case, the investor came who took 10%, so nothing changes until there. But the second investor who came with 20%, the investor who came in 10%, their shareholding still stays 10%. So the 20% comes from you and me.
Mm-hmm.
Now, imagine it is happening. Second safe note, third safe note. So only one who's diluting are the founders, not the investors. And it has suddenly, out of the blue, become industry standard. And nobody knows the implication. So this is just one example of how critical the cap table is for the company. Because sometimes founders say, oh, we are stacking safe note, but we've just diluted. They don't even understand the dilution impact of those stacking safe notes one after the other. And when they actually issue the shares, they are shocked. Because in their mind, they've just given away 20% of the company, but when they see they've lost almost 40% of the company. And what happens by the seed stage or pre-Series A stage, you have already given 40% of the company, then your company becomes uninvestable. Why? Because you already have too little in the company. And building a company is a long haul process, right? It's not 1 or 2 rounds. It's perhaps a 10 years process or perhaps 15 years process, and you do multiple rounds. So if you're just owning 60% or below after first round, by the time you are at the Series B, Series C, you'll have very little incentive, and that might not be enough for you to get going. Because founders, you have to understand, founders' mindset is not very different from employees' mindset, because you need to have skin in the game, enough skin in the game to fight that battle, right? And if there's very little equity left, then as a founder, I'll say perhaps it's not worth the effort anymore. I'm working 16 hours a day. I've gone through the grind. It still seems to go nowhere. Perhaps it's time for me to give up because there's very little left anyways. So that's a long way of me saying the lack of awareness is incredibly high. But still, founders refuse to listen. They say, because they talk to their friends and their friends tell them, hey, I used cap table for Excel cap table, and I know everything. And then they say, maybe perhaps if somebody is advising them to use true digital cap table tools for them to get full picture at all times, they refuse to do that. So a lot of education is needed in this space. Does that answer your question?
Absolutely. But out of curiosity, why, one model became like, is it like because they don't know how to value the company? I mean, the post-money valuation, like you said, like it became like the more used one. So is it like, because it's easy for them, it's easy, like, why? I'm just out of curiosity, like I want to understand. And this is when also like, it's kind of a loaded question, I know, because one of the points that people ask about a lot, and all the time, how do I value my company? Especially, for the ones, okay, so the revenue generating ones, there are kind of, I would say, best practices and, common methodologies to do this. But especially for the ones who are still maybe in the early stages, maybe this is why they need to go there. Like, I'm just, I want to get this wisdom out of you, Gagan.
So actually there are multiple questions, but I think I'll go with the first one. Sure. Why the change was made. So this change was even good intentions, actually. There was no bad intention at the Y Combinator, because the issue was that investors started complaining. So because when it's pre-money valuation, I don't know the exact percentage of the company I'll be holding, because you keep on raising new safe notes, money through it. I don't know. And by the time the conversion happened, as an investor, I think I own 10%, but you have raised so much safe notes ultimately, but my percentage is 7%. So investors were not happy. So this change was made to make investor comfortable and to give them the exact shareholding they'll be holding. So I know I own 10% no matter how many safe notes. But that was the idea, to give investors visibility. And it works perfectly well if the company is just raising 1 or maximum 2 safe notes before doing an equity round. Mm-hmm. But what's happened in this part of the world was, because of this funding winter and the lack of access to capital, very little equity rounds happened. So founders, because of the lack of awareness of the implication of these safe, kept on raising multiple safes, 3, 4, 5, 6 times. So that led to a major impact onto their shareholdings. So so that's a long way of me saying the idea was to give investors full visibility on the exact shareholding, but because founders started using it way too much than what it was originally imagined to be, the implication of them was quite disastrous.
Right. And what about the valuation of the company, Gagan?
So valuation, again, it's actually it's quite a different topic, and I'll need to spend a lot of time explaining to you. So valuation for early stage companies is done very differently for late stage companies.
Right.
And early stage companies, it's more of an art rather than science. I'll be honest. Yes, there are so on a broad basis, there are three different methodologies for the valuations that are used by the investors. One is the discounted cash flow. What does that mean? That based on the business plan that you're projected to the company, the company calculates the free cash flow. Your business plan shows the free cash flows the company would be generating in the years to come, and those free cash flows are discounted based on the inflation rate, and then the enterprise value is calculated. Okay, that's one way of doing the valuation, discounted cash flow. But most of the startups for the first few years are actually not having free cash flow. They're investing into the business. So the DCF, discounted cash flow model, is sometimes not very workable for them. So, but it works perfectly fine for B and C stage company onwards, which have passed through profitability, because then it makes sense. But during the early stage, nobody knows, and all the projections are anyways will go up for a toss. And so everybody knows that, so it's not very commonly used. But it is one of the methodologies for valuations. The second one is, and I think one of the more common ones, is trading multiple, where every industry has a certain trading multiple. It can be a multiple of your revenue number, or it can be a multiple of your gross profit number, or it can be a multiple of your EBITDA numbers. But EBITDA, again, most of the companies are burning money during the early days, so EBITDA is zero or negative, so it doesn't make sense. Typically, it's a revenue number multiple is taken, and it varies per industry. Like today, generative AI companies with revenue have a much higher multiple than traditional e-commerce companies, and keeps on changing. So that's the second. And third is a precedent transaction. Precedent transaction is to look at the similar transactions that have happened either in the public market or in the private market, and they take that number as a benchmark. So out of these three methodologies, the second one, that is the trading multiple, is very common, right? So that's how the valuations are coming. But coming back to your original question, how will I value my pre-seed company, pre-revenue company on day one? So in that case, the numbers work. There's a reverse calculation. How it works is, so it is not advisable to founders to not dilute over 20% of the company, 25% in the extreme places, but typically it should be 10 to 20% dilution per round, right? If you as a business, you feel that you need $2 million, so you should aim at not diluting anywhere between 10 to 20%. So 10 on the lower side, 20% on the higher side. So that means that your company's pre-money valuation naturally, even on day zero, becomes anywhere between 4 million to 8 million. So if you value 10%, then your pre-money valuation is 8 million, because pre-money, 8 million plus $2 million that you get. So the total post-money valuation becomes 10 million. So that's how it works. So based on the percent, the quantum of financing you are seeking, that's how you will be diluted. But that doesn't mean that people should say, okay, then it's wiser for me to raise larger capital early on, and that would help me dilute, and naturally makes my company's valuation. Yes, theoretically that makes sense, but you have to understand, higher valuation backfires a lot more often than founders can imagine. Because if you're raising your early stage rounds at an 8 million or 10 million valuation, then by the time the next investor comes, you will have to raise at least 2x the valuation, 20 million. How will you justify that? During early days, you probably played the game of business plan and investing and everything. But if you're not able to perform as your business plan, it will literally backfire, and then your company becomes very expensive. And then you have to go through the down round process, which is again a very different discussion. So what I'm saying is, be very careful, price their companies in such a manner where it doesn't put pressure on them on the following rounds. Because as I said, it's a long haul. So you have to think for the future. So the correct balance is try diluting 10 to 15%. Make your raise in such a way that you know that your following round you will be able to raise at a 2x valuation. So that's backward calculation should work.
That's very, I would say, helpful to I think a lot of founders. Gagan, thank you for sharing that. I'm sure like this part of the podcast will be the most listened one, because I get this question a lot. I always get the same question and again and again. Now, coming to one thing which is good, I'm liking the flow of our discussion today. So you talked about the funding winter, right? So and you lived it also, and I'm sure like you have seen it all, as we can say. How
More
hard
than I wanted. Let me tell you this.
how hard it is to raise fund. And one of the things that of course you spot this in the market, is how startups can really prepare themselves to fundraise from VCs and maybe angels. And that's usually we talk about VCs, of course, like in our, especially like the tech startups. So it's usually like it's with the VCs, especially when they have maybe raised from family and friends, and then they want to go to the next step, right? So here again, like you've built something fantastic. I've seen it, I know it very well, which is like matching the investors with the startups. But what you have done is you gave them this ability to build their virtual data rooms, right? So now, again, this is, I believe, one thing that a lot of people are not aware about, and I think they need some education from the best. So first of all, let's start, about the importance of building the data room early, even maybe before you start to look for the investors.
Okay. So, Mehmet, data room is a great question, but what I would want to do in this case is to just create the framework of the entire journey.
Please.
People will understand better what is the importance of data room. Because if I just jump to the data room, then a lot of context that I want to give to your audience, we might lose it. If that's okay.
Of course.
So you said how difficult it is. It's incredibly difficult. We all have seen the data. I was looking at the Statista report. Again, this is Southeast Asia data. So the total funding has come down by roughly 65%. So in 2022, the companies roughly raised $29 billion, which dropped to like $10 billion, under $10 billion. And the number of deals above $100 million also dropped by around 65%. So it's not good. And 2024 is also slow. Things are improving a little bit, I'll say, but still nowhere close to what it was in the peak time of 2021. It might not be the bad thing also, because the market needed correction, much needed correction. The companies were being overvalued. There was too much free capital running in the market. So I think it's good, because now people are forced to build fundamentally solid business rather than just raising on optics. So I hope that answers your question. That's tough. But for the right companies, there's still enough capital in the market. Now, second thing is, before any founders want to start this journey, I tell them to brace yourself, because it's going to be incredible tough, because it's extremely resource intensive. And it's not just resource intensive for the founders because they're pitching to so many people, but it's also for the team members. It can be the CTO, the operations person, if they have a finance person as well, because the founder will need all these people support during the due diligence process. So,
right.
So it requires a lot of resources and a lot of founders' time and their team members' time. So they have to brace themselves for a journey. Second is it's a quite complex process because a lot of terminologies that we are using: valuation, pre-money, post-money, liquidation preference, anti-dilution. Founders need to learn this, unfortunately, because if you don't know the deal you're getting yourself into. So it's a complex process. So founders need to spend a lot of time educating themselves. Probably, perhaps this podcast would be one of that medium when founders listen to it and try to understand what to do, what not to do. Third is networking and relationships. You have to meet a lot of people. You have to kiss a lot of frogs to find your prince. So yeah, meeting a lot of people, perhaps partners, going to events, pitching competitions, creating founders branding. That's another big thing these days. Founders should build subject matter experts. So all these networking and relationships take time. So it's at least a 6 months process. Earlier it was 4.5 months, but the time tenure continues to increase. Now, long process to brace yourself. Now, the first thing which any founder should do is take the founder's fundability test. It's extremely important. So I'll tell you what is that. So founders should be aware of two T's. One is a track record, and the second one is traction. Mm-hmm. So I created kind of an x-axis and a y-axis chart. So on x-axis is track record, and y-axis is traction. So what is a track record? So if you have no track record, then the chances of you getting funded are very low. But on the other hand, if you're an Ivy League student, you have a Stanford's, Harvard's, Kellogg's, Princeton, you naturally become more fundable because there's a certain a track record there. If you're a C-level or an exec of a FAANG companies, for your audience who don't know what FAANG companies are, FAANG is FAANG. That's Facebook, Amazon, Apple, Netflix, and Google. So these companies are so if you come with these blue chip companies, then your fundability is higher. And last but not the least is if you already have a track record of building a company, exiting 8 figures, 9 figures, definitely everybody would want to back you. Absolutely. So that's track record. But if you don't have a track record, then the only way you can get funding is you have a traction. So if your company is growing month on month, 20%, 30%, then definitely, no matter what your background is, clearly have built something meaningful for the market, and the investors will flock and work. So if you imagine a graph, so if you have to position yourself, okay, if I have low traction, no track record, you'll barely get anything. But if you have high traction and you're from exited founders, clearly you'll have more money that you actually need. So you have to position yourself. And so sometimes I see founders or first-time founders don't have an MVP complaining about investors not investing in them. But I think it's unfair on their part because you have to see investors are playing this big game. It's a high-risk game, and they are looking for 100x investment. So you are, in principle, by accepting that money, promising them 100x returns. Mm-hmm. So not every business is VC backable. That doesn't mean it's a bad business. It can be an incredibly profitable business. But VCs have a certain way of investing because they're looking for 100x returns, 1000x returns, outliers, the companies which can become $0 to $100 million within the first 5 years of operations in terms of revenues. So not every business is programmed for that. So what I'm saying is sometimes know thyself. That's what I say. Know yourself, acknowledge the reality, and then set your expectations. Because once you take VC money, there's no looking back. Then you are playing that. You agree to play that game. You've agreed to promise them return in principle. Then you have to perhaps do anything and everything in your capacity to grow. And if it doesn't go wrong, then it leaves a bitter taste in everyone's mouth. So yeah, know yourself. Now I'm coming to your main question, virtual data.
Right.
Now, I come across so many founders, man. It's unbelievable. They're saying, Gagan, I'm fundraising and this. And I was like, okay, send me your data room. He said, I don't have a data room, but I have a deck. And that really bumps me. In fact, personally, last month, I lost a deal because of the lack of data room. So I'll tell you, investment is a very emotional process.
It is.
If I'm an angel investor, for example, I come across a founder like you. I like your energy. I like your grind and your vision and everything. You might get me excited. I'm like, yeah, man, I'm going to invest in your company. Send me your data. But then you take 1 month, 1.5 months to prepare your business plan, your management accounts, and your KPI reports, your cohort analysis, everything that you expect me to see before investing in you. Because due diligence is an integral part of your process, right? Of investors' process. So, and then you take 1.5 months to send that information to me. But by that time, I'm not excited anymore. Something happened in my life, or I spoke to some of my other friends who talked to me, say, hey, I knew another guy who was doing that. It didn't work out. So I lost that momentum. I lost that enthusiasm. And then you come back to me, hey, Gagan, this is your data room. Please look. I say, Mehmet, probably I'll pass this time. Because you lose momentum. So it's extremely important for founders to be due diligence ready and create everything in the virtual data room. Do not use Google Drive. Because Google Drive is a very unsecure place. So now the world is changing. There has been so many frauds happening in the startup world. that founders want proper corporate governance, and the best form of corporate governance is a proper secured virtual data room where you can track everything who's viewing the files you are, and the investor also can ensure that these are the right files, watermarked and everything, that you cannot play on game like, okay, this was not the file I wanted to send this. So it standardizes the entire process while giving comfort to both the parties. So what I recommend to founders is first get DD room ready. Like not just your deck, but your business plan, your management accounts, your key KPI metrics that you are tracking, your tech stack report, be ready. So that if you do a good call, right? If you get the founders, investor excited, immediately get the NDA signed and send over the data room within the next 24 hours. That's how you're keeping the momentum. And I actually lost a deal because there was a great conversation the founder did. We matchmade. It was clearly a done deal. Investor called me after that. Thanks for bringing this. I'm clearly going to do that. Took 2 months to prepare the data room. Investor changed her mind. So do not on that. So virtual data room is a very integral part. It's your like a depository where all the key things about the company that you expect an investor to do the due diligence on should be there, and it should be ready prior to you start pitching the investors, not after.
Like 2 things, just quick 2 comments from me, like about your point. I think, and this is something I don't know why it is there. Is it like because they saw it in the movies, they read it somewhere? So a lot of people, they think, okay, like, let's say I'm the founder, you're the investor, I will pitch you. And then, at the end, it's like a kind of a Shark Tank thing. Okay, I'm going to invest money in you. I think some people, they have this, they don't know what happens in the background. They don't know, like after, okay, so let's say you talk to a VC, probably one of their, I don't know, maybe an associate first, he will talk to you. And then one of the partners, he will talk to you. So there's like a process that happens. And then after you finish all your presentations, they will go back to the due diligence, and then they will this is where they will ask you, okay, send us your data room. And I think people, they think like, it's like, I will let's say do the pitch today. After 1 week, I'm gonna have the check in my bank account, which doesn't happen. The second thing, which is, I think it's because again, this is all from my personal experience. Again, when I speak to founders, I start, because of course I had to understand it myself because I was ignorant also. I didn't know it. So VCs, they have, they don't have unlimited money, right? So they have a fund, and this fund, let's say they have to deploy it in certain amount of time, and they need to, for example, they project, okay, we're gonna invest in X number of companies, our average, right, the investment will be such, and they need to be selective from their side. This is where they would go and ask for the due diligence. And I think this is like these 2 things, a lot of founders, it's not like because they don't want to know. No one told them, actually. And this is why I'm happy I'm doing this podcast with you again today, because it enlightened a lot. And the good thing is that what you did with while building Wows Global is that you made this ready for the founders, right?
Yeah.
I mean,
So actually, this is a problem that we were trying to solve for the investors as well, ma'am. Because as I said, I've been an investor myself. I was a part of a fund. Then I also did few deals in the angel capacity as well. So my problem was that there was a lot of back and forth. Even if I like the company, I like the idea, I'm looking at this logistics space. I want to invest in an early stage logistics company who's growing decently, 100% year on year. Now I get that information, but that's pretty much it. Then there were like 100 email exchanges between me and the founder, and that was tedious. What we do is at Wows Global, we make the decision-making process for investors super easy. Everything is organized. Everything is as per international industry standards. No Excels, nothing. Everything is properly laid out. The company's 1-pager would be very nicely done automatically on the platform where key information are there. Pitch deck you can move. You can request access to the data room. NDA can be done, and then you can deep dive into the data. So typically the back and forth between the investors and the company used to take, say, 2 months. We reduce that time to less than 2 weeks for you to do the due diligence. So we don't guarantee investments. We are not saying that we oversell your company. No, we don't do that. But we at least expedite the decision-making process. That's what our value proposition to companies and investors is. The companies is we are going to organize in such a way that you'll know the decision in 2 weeks rather than hearing the no after 8 weeks. Because we deal on the platter to the investors. Everything is there. They can deep dive, check. Okay, yeah, nice. probably interested, or not nice, not interested. So the back and forth that is typically done, which is exhausting, we remove that.
Absolutely. And, I think for investors, one of the, things that it's all for them, and this is maybe a lot of founders, they don't know, let's share like some secrets, is that, don't think the VCs themselves are not always looking, and they need what we call a deal flow for them, because when the VC, they raise money themselves from LPs, limited partners, and then they have also, the clock start to tick the moment, they have the fund in their bank account and they need to start investing and deploying the money. So Gagan, like, how have you seen investors' reaction to what Wows Global built? Because, you bring to the table for them also like deal flow as well, maybe something that it wasn't under their radar, maybe their associates and the people who their scouts, as they call it, they were not aware of. So tell me about like this part from the investor's perspective.
That's a very good question. So I think you made a very good point that VCs get money from LPs, right? And they have to deploy it. But VCs also have their own budgets. You have to understand. Right. So the way VC model works is 2%, 20%. What does that mean? So 2% is management fee, 20% is carry interest. Complex. I'm going to explain it to you. So management fee is, because when the VC is running a shop, they have some expenses, right? They have to hire analyst teams, they have to hire officers, they have to travel, and there are a lot of other administrative costs, even the accounting and audit fee for the fund that needs to be done. And that comes from the fund size that they have raised. So VCC has raised $100 million fund. This is on a very high side. So you get $2 million every year to manage the fund as a management fee. And then you make investments. So whatever investments you make after that, say you invested, say, $80 million, hypothetically, or $98 million, right? Mm-hmm. But then the exit value was $130 million. Then on the $32 million that you made on the investments, you take 20% of that as a general part. That's how it works. So now, but these numbers sound very good, right? 100 million, but not most of the VCs are small VCs, right? So they have very limited management fee. So they cannot hire analysts everywhere across in all the markets. And the Southeast Asia particularly is very fragmented. Singapore is very different from Indonesia. Indonesia is very different from Thailand. Vietnam is a very absolute different market than Philippines. So it's not possible for VCs to have analysts on the ground on their payroll, in each market, right? So we act as one of their analysts on the ground. And what we have built is a robust technology. Like once you fill the application on the form, a system tells us how. We have an internal algorithm that tells us whether you're fundable or not. And if you're not fundable, then we don't openly pitch you based on our assessment. We might be wrong, but at least what algorithm that we have built, it gives a very good indication to evaluate. Most of the VCs even today are using Google Forms, right? But there are a lot of intangible things like founders' LinkedIn profiles, checking their university's backgrounds. That's another soft skill element that comes into play. And there are multiple other bases on which we evaluate the company. So I think we have automated a lot of process, which allows us access to much better companies than typical analysts, because we built a branding over these 3 years. We spend a lot of money on marketing. We do a lot of events. So that's a long way of me saying that we have teams on the ground. We have relatively higher budget. We are operating our company as a startup. So we have teams on the ground in each of the market, and then we act as a deal flow partners for the investors at zero fee. So there's no harm for them to use us, right? Even if they like, we've been charging them, then of course there's a question comes. But we act as a deal flow partner, and they trust the algorithm because of the credibility that we have built in the market. So I think it's a win-win for everyone.
It is a win-win, of course, again, because, we talked about it even when we met the first time. It's solving a problem for both sides of the table, right? So getting the founders funding ready, as you mentioned it, this is very important, I believe. I want to highlight it. And at the same time, get the deal flow for these investors. And that, you explained the model in a very, I think, clear way for everyone. Now, you have a bigger goal is to democratize, the whole funding journey for both sides and deploying the funds and, get funded. But, you started with Southeast Asia and, I read the reports there and it's like the trends is like, you mentioned some statistics, but in the future, how are you seeing this? And I can relate also to Middle East and Africa also as well from my side. So how are you seeing the trends in the private, in this market, the private equity market and in general in the startups and the VC world? So what are you seeing in Southeast Asia?
So talking about Southeast Asia particularly, Mehmet, the exits have been a massive issue. Massive issue. You can kind of count on fingers how many IPOs have happened in this part of the world. And most of the companies, in fact, I think all the companies didn't do very well post-IPO. So the problem which most of the companies today in Southeast Asia are facing is they are either too small for IPO, or even post-IPO, the retail market completely disregards them because the unit economics are not that great, most of the companies. And on the other hand, they're too big for M&A. Because if you are like $200, $300, $400 million, there are very few buyers at that scale. So I think Southeast Asia needs to find their sweet spot. So now the players like us have a massive opportunity of not just helping companies in the fundraising, but also perhaps find them early liquidity or exit opportunities in the form of small, in the form of trade sale or M&A opportunities, because the region is ripe for consolidation at the moment. I think that too many players in the market in almost every space, and everyone have their own share, but it's not sizable enough. So the market needs consolidation, and that perhaps we'll see in the years of come, in the future years, where you see a lot of consolidation happening in the market. So two things: one is consolidation, and second is small M&As will grow, and that's where the platforms like us will have even more opportunities because we will help source. So we already have all the infrastructure in place technology-wise, and even on the buyer side, we continue to expand our network. So now, for example, somebody who is running a logistic company in Europe wants to expand to Southeast Asia. So through platforms like us, they can get access to those companies because we have a vetting process and everything. And at the end of the day, they only invest or buy if the numbers make sense to them. But at least we give them access, which previously they had to pay a humongous fees to the boutique investment firms in order to even get that kind of access.
Absolutely. Just, before I put my comment on the MEA market or MENA market, any specific sector you see like kind of boom in Southeast Asia?
I mean, boom. See, generative AI is hot, but I think most of the companies who are positioning themselves as AI are not really AI companies. So yeah, these are attracting funding, but I think it's still a wrapper companies. That's what I call them. They have used existing OpenAI or Gemini solutions and built on top of it, which I don't think makes them a true AI company. But it continues to be hot and attract a lot of capital. But I think in Southeast Asia, fintech continues to be hot. Like it continues to attract a lot of capital on the credit side, on the B2B buy now, pay later. That's getting hot. Payments is a bit saturated on the consumer side, but the B2B payments is still pretty good. So I think, and I was looking at the data actually. So even in 2023, fintech continued to dominate. It was the most funded sector in this part of the world. So AI, we are yet to see a true revolutionary product coming out from this part of the world, but there are a lot of companies. So yeah, I think it's more like it's similar to what some people won't like this, but I think it might have the same outcome as what perhaps metaverse companies had because it was hot at one time, but not. But I think fintech is still, there's a huge opportunity. I think you don't need to disrupt the market like completely with a novel solution. There's still within the existing segment, there's so many opportunities, I think, right for disruption. So I think that answers the question. So fintech today, what in this part of
definitely, Gagan. By the way, like what I'm gonna say now very shortly is actually similar to what you mentioned, but it applies to the MENA region. First, like UAE is different than Saudi, different than Egypt, different, than Morocco and all this. So this is applies the same thing. And I think also like I had an episode with the founder of MoneyHash, which is one of the fintech companies that enables actually like other payment or like fintech companies with the infrastructure. So we had like the same thing. Like we're stuck in a way that we're not going to an IPO, and at the same time, on the verge of staying like in this mid range. Very few now are making it, and to the point of the trends, actually, it's a kind of we didn't see this AI attracting, or actually, I didn't see much of AI startups, but the fintech keeps booming. Actually, the latest number from H1, at least in the MENA region, so fintech still dominate. Now, the two major BNPL companies, one of them is going after an IPO because, they grow so much. And I believe, the same thing applies, but I'm a big believer, I have to say this, Gagan, like I'm a big believer in our markets, like most of our markets, like the Southeast Asia and MENA market. And the reason is because from my interaction with you and, like other people in Southeast Asia, and for me, because I'm here in Dubai, what excites me, like, of course, all the investments, the money and the exits and all this, but I think the talent, right? So I see the talent because we know a lot of people, they go, for example, to Singapore, to Indonesia, to Thailand, like all these great minds, the great people who sit there. And same thing, I'm seeing like a good talent pool here in the Middle East, especially in Saudi and UAE. And the good thing also is the shift, which is slow, but it's good, it's happening. Also this, like we don't invest in less than like Series B or Series K companies. I'm talking about the local VCs here. So this is quietly changing where money is being deployed in the early stages also as well. So this is probably will help us, to see like more dominant, startups in their domain. So I'm hoping for this. And like as we want to wrap up this again now. So where's the best way to, whether I'm an investor or I'm a founder, to get onboarded on WOWS Global?
I mean, just go to our website, www.wowsglobal.com. WOWS Global spells that WOWSGLOBAL.com. You can sign up. Our customer service team will reach out to you, and we can help you do concierge onboarding. But otherwise, also the tool is very, I'll say, self-manageable. And so our system tells you the exact steps you need to take in order to create your profile if you're a company. And also, if you're an investor, you need to be accredited as an institutional investor to apply for it. So we do a little bit of KYC, but then once you pass our KYC, you get access to the platform right away. So very simple, seamless process. And the best part, it is absolutely free for both the parties, companies and investors. Yes, we have tiers planned, but as you want more solutions, of course, that would be chargeable, but you can get started at $0. That's the best part. So I would really appreciate if all your audience try it out and give their feedback to us.
Yeah, and for people like if you are in the MENA region, reach out to me directly. I can guide you on this journey also as well. Because me and Gagan, like we wanted to, like the same thing. By the way, what Gagan have done with the team, of course, in Southeast Asia is fantastic. You changed the game, Gagan. I can see this. You should follow Gagan also on LinkedIn. I highly advise you because he shares a lot of insights and, valuable information for both parties. So make sure you follow him. And at the same time, like follow WOWS Global because the guys there, the team, marketing team, Gagan, they do fantastic job also sharing these blogs and articles also as well, organizing events. And we will plan something for the MENA region also from events perspective very soon. So stay tuned for that. Gagan, really, I enjoyed the conversation. The time really flew very, very fast. So thank you for your time.
So I always say speak to you, Mehmet, and thank you for having me on your show. I hope it was valuable for your audience.
I'm sure it is. So again, thank you. And for the audience, the links that Gagan mentioned, they will be in the show notes. So if you are listening on your favorite podcasting application, you will find them in the show notes. If you're watching this on YouTube, they are in the description. And you can reach out to me also directly for anything like you want more information. I'm happy to arrange a call with Gagan also as well. So reach out. And as I say always, thank you for tuning in. If you just discovered this podcast by luck, thank you for passing by. If you did so, subscribe and share it with your friends and colleagues. And if you are one of the people who keeps coming and send me their requests, their questions, comments, keep doing so, because I read really all of them, and I value your feedback, whether it's something good, something bad. Please tell me. I would love to see how I can make this better. Thank you very much for tuning in, and we'll meet again very soon. Thank you. Bye-bye.
Bye-bye.
Hit that subscribe button, share the show with your tech-savvy friends and fellow entrepreneurs, and leave us a review on your favorite podcast app. Your support means the world to us.